Welcome back to the deep dive. Today, we're going to dig right in, focusing on the strategy at Lovesac,
And we're going straight to the source, the Q&A from their Q2 earnings call.
which is always the best part, right? The prepared remarks are one thing, but the Q&A is where the real story comes out.
It is. That's where you hear analysts push on the tough questions.
Yeah.
And our mission today is to get past the headlines about them lowering guidance and really pull out the strategic insights. I mean, how is this company navigating these huge headwinds, tariffs, a crazy promotional environment, a slow housing market, all at once?
And we've got a lot to go through. It really looks like a company that's fighting fires with one hand and, making these huge long-term investments with the other. We're going to talk about their new Snug platform, the financial pressures, and even their ambition for domestic manufacturing.
Exactly. There's this real tension between the short-term pain they're feeling and this deep long-term confidence. For you listening, this is a fantastic look at how a brand tries to pivot its whole structure right in the middle of a really tough economic cycle.
Okay, so let's start with that pivot. The big strategic shift, which really begins with their whole brand evolution and the launch of this product called Snug.
Right. The CEO mentioned a new CMO is on board and that we should expect a pretty fundamental change in how they advertise and communicate.
This is a big deal. They're trying to move from being just the Sactional company to a full modern home brand.
And the new Snug campaign is the first real sign of that. You might remember it was called EverCouch internally. This campaign with Brittany Snow, it just has a whole different tone.
A really confident one. The president basically said the message is a direct challenge to the old school couch industry. It's like they're saying, anything you can do, we can do smarter and better.
It's an aggressive move.
Yeah.
But if you connect that message to the actual product, Snug isn't just a new sofa. It's about rethinking their entire distribution model.
Because Sactionals are, as the CEO put it, a wildly complex product platform.
Wildly complex. And that complexity, while great for customization, it needs a lot of customer education.
Which means expensive showrooms and highly trained staff.
Precisely. That's a high fixed cost base. It's hard to scale that quickly. You need the showrooms, the staff, that whole intricate in-person demo.
But Snug is designed to get around all that operational friction.
That's the key. It's simpler, the sofa, a love seat, a chair. You still get the core benefits, washable, comfortable, movable. But, and this is the important part, it does not need that intensive hand-holding.
So it's designed to be sold online.
Primarily. The main channel is their website. This unlocks future growth in any channel that doesn't depend on their own specialized, expensive staff. It lets them cash in on their brand recognition without having to build a ton of new stores.
Okay, so a whole brand refresh, a new campaign. You'd think that means a bigger marketing budget.
But that's not what they said. The CEO was very clear. They are not thinking about increasing marketing spend. The goal is to get more efficient.
Spending smarter, not more.
Exactly. The cost of this whole brand refresh has already been absorbed. And he talked about a meaningful shift in where those dollars are going.
Away from linear TV, I saw that.
Yep. Moving that money into digital platforms where they can target customers and actually measure the return on their spend. It seems like they're trying to use marketing efficiency to help pay for the financial headwinds they're facing everywhere else.
Which brings us right to those headwinds. I mean, this is where it gets really painful to look at the numbers.
It is. They had to lower their gross margin and EBITDA guidance because of two huge external factors. The CFO literally called it a perfect storm.
Tariffs and discounts.
A perfect storm is right because it squeezes them from both the cost side and the revenue side. First, the tariff shock. I mean, this was massive. The president explained that the rates for their key sourcing countries outside China, places like Vietnam, Malaysia, they basically doubled.
Doubled. So from what, like 10% to almost 20?
Yeah, from about 10% to 19 or 20%.
Yeah.
That's not a small increase. That's a structural bomb dropped on your cost of goods sold.
It happened almost overnight.
It did. And to make it worse, their progress on moving some of the more specialized production out of China, things like the high-tech components for stealth tech or custom fabrics, that's been slower than they wanted.
So the highest tariffs are hitting the very parts they're having the hardest time moving.
Exactly. So your input costs are skyrocketing because of government policy, and then at the very same time, the CFO says they're required to ramp up promotions because the whole category is so competitive.
They're getting crushed by competitors trying to dump inventory.
It's the classic squeeze.
Yeah.
And that's why they're saying Q3 is going to be the worst of it. It's all about lapping the prior year.
Okay, let's unpack that. Why is Q3 so much worse than Q4 is expected to be?
So in Q3, you've got the full massive weight of those double tariffs hitting them. But on top of that, you're comparing this year's Q3 to last year's Q3, a time when they were much less promotional.
I see. So the year-over-year comparison is just brutal.
It's brutal. If you went from a 10% discount last year to a 20% discount this year, that difference just demolishes your margin for the quarter. The CFO said it's several hundred basis points more impact than in Q2 or Q4.
Okay, so what's the relief they're seeing in Q4?
Two things. First, the tariff burden starts to ease up a little bit as they get more sourcing out of China. But the big thing is that promotional comparison gets easier.
Because they were already starting to discount heavily by the end of last year.
Correct. They start lapping the period after last year's tough Cyber 5 when they had to step up the pace of promotional offers. So since they were already discounting heavily, the year-over-year change isn't as dramatic.
That makes sense. It's all about that rate of change. So how do they get back to their long-term goal of, what was it, high 50s, near 60% gross margin?
They laid out 5 key levers they can pull. These are the things they can actually control.
So which of these 5 is the biggest challenge, and which one can give them some relief the fastest?
The heaviest lift, no question, is lever 2. Continuing to realign their countries of origin. That is a massive, multi-year supply chain overhaul, building new vendor relationships, quality control. It's a huge project.
But it's the only way to permanently solve the tariff problem.
It is. The most immediate help probably comes from lever 1, optimizing outbound logistics. Things like warehousing, testing, last-mile shipping. That's internal stuff. They can do it now and save a few basis points here and there.
They also mentioned new delivery options and return policies as lever 3. That sounds like passing some of the cost to the customer.
It is, and it's smart. If you want white glove delivery, you pay a premium. Tighter return policies on huge items save a ton on logistics. It's about protecting their margin internally.
Then there's lever 4, which is getting away from those big store-wide discounts. They talked about a variable strategy. What does that actually look like?
It means being surgical. So instead of 20% off everything, maybe you offer a deep discount on Snug Online to grab market share, but you hold the line on your premium sectional configurations in the showroom. You manage the total discount level down.
And the last lever, number 5, is just hoping the competition stops panicking and discounting so much. That feels risky.
It's the wild card for sure. It's the one they can't control. They have to show progress on the other 4, because if the economy stays weak, who knows how long the discounting lasts. But I think their bet is that a lot of competitors can't afford to keep it up as long as they can.
Okay, that's a great breakdown of the immediate fight. Let's pivot to the future, the big investments they're protecting. First up, the new room category they've been teasing forever.
Yeah, analysts were really pushing for a timeline on that. The CEO had to confirm that early calendar 2026 is not realistic anymore.
So a delay. But he was adamant that when they do it, it'll be game-changing, not just trickling out a few products. What does that tell you?
It tells me they have discipline. They're protecting that R&D budget. They're not going to rush out a half-baked product into a weak market just to hit a deadline. They're waiting to launch it for maximum impact.
Now, one of the most interesting long-term plays is moving manufacturing closer to home. Made in the USA. The CEO called it a passion point.
And it's way more than just a marketing slogan. If you pull this off, it's a massive strategic win. Most furniture companies can't do it because a traditional sofa is just too big and complex to build onshore cost-effectively.
But Lovesac's modular design changes the equation.
It changes everything. It's about standardization. A seat frame they made today has to be identical to one they made 5 years ago. So they aren't making 1,000 unique sofas. They're making millions of identical components.
And that kind of volume is perfect for automated domestic factories.
Perfect. It gives them economies of scale that competitors just can't match in the U.S. It cuts tariff risk, shortens supply chains. I mean, it's a huge advantage. He said they're closer to it than ever.
And that all ties into their Recommence platform, loved by Lovesac.
Yep, it's expanded from Texas into 5 more states. This is all about strengthening that long-term value proposition.
It tells the customer their big purchase holds its value.
Exactly. And they're even piloting a trade-in program. That's the ultimate flywheel. They get the used product back, refresh it, sell it again, and pull that original customer right into a new purchase. It's brilliant.
And one final point that shows their brand is holding up. Even with some price increases to offset costs, customers aren't trading down.
That's maybe the most critical data point of all. People aren't switching to cheaper fabrics or fills. They're paying the slightly higher price for the premium product they want. In this environment, that kind of pricing power is a really strong signal of long-term health.
So the big takeaway for you, our listener, is pretty clear. Lovesac is navigating this incredible external pressure by getting really tight on expenses and smart on marketing.
But it's not a defensive crouch. It's a strategy of patience. They are protecting those core long-term investments, the brand, snug R&D, domestic manufacturing, because they believe those are the things that will let them dominate when the market turns. They're taking a margin hit today for structural superiority tomorrow.
And learning that Snug was literally engineered for channels without staff, or that their modular design is what makes U.S. manufacturing possible, that's the kind of insight we look for on this deep dive.
It's a fascinating case study. But it leaves me with one final thought for you to chew on, going back to those financials.
Given how much pressure they're under in Q3 from tariffs and promotions, which of their two big categories of fixes do you think will be more effective in the short term? Is it their internal controls, logistics and supply chain tweaks? Or is it their external market strategy, the variable pricing and new return policies? Which one will stabilize them faster before that game-changing new category is even ready? It's really a race between their operations team and their marketing team.